So it's a very good question, and I think this question is relevant for most investors today who look at Section 80C. So as I said, typically people will go into the rush hour, which is my experience with people over the past many years. I've seen that people declare in April, and when you get this email from your employer, you typically go to a financial advisor, or you end up buying instruments just off the shelf. You don't go to check whether this instrument is useful to me, whether I can meet some goals out of this instrument, or what do I do of this over the long run. So it's very important to plan before you buy these instruments. So to answer this question, as I said, there are assured returns products, so no denying the fact, and there are some of these products offer different interest rates. But if you see over the past few years, interest rates are on the decline.
Right.
So if you look at, say, the late 90s, you had interest rates which were in the 12 and 14% range, but I'm sure that you would not get some of those returns from assured returns products going forward.
Right.
So just 2 days back, you found that employee provident fund rates have also been dropped, though slightly. But if you look at bank FDs or any of these assured returns products, you generally find that the rates are on the decline. So what do you do when rates are on the decline? You have to earn, the returns to meet your goals.
Right.
Your goals are also getting pricier. So look at, child's education, or, your retirement, etc. They are getting more and more pricier. So you need to look at instruments which can give you better returns. Of course, the question that why should I look at equities? General feeling in people's mind is that equity is risky. But have I looked at options of mitigating that risk? So there are ways to mitigate a risk. So if you're getting equities and they have the potential to get higher returns, it is very important that people capture those higher returns. Now, how do you do that? One is that look at mutual funds. Why do I say look at mutual fund? Not because I'm working in this industry, but because you don't have to choose the stocks. Earlier, you were saying that what if my calculation of choosing the stock goes wrong?
Absolutely.
You don't have to choose the stock. We have portfolio managers who are professionals with decades of experience who can choose the stocks for you. So they have a portfolio for you within an ELSS fund. So that's one good way of mitigating the risk of choosing a stock. What else can you do to mitigate the risk? You can stagger your investments. As I said, again, you need to plan for this ELSS. You should invest across time frames. So you need to invest, say, on a monthly basis. Mutual funds offer you an instrument or a device called SIP, which is a systematic investment plan, and you can invest some amount monthly. So if you want to save 1,50,000 a year, you can invest 12,500 every month, and trigger that through your bank account. So you can autopilot the whole thing, and automatically by the year end, you have saved 1,50,000 through an SIP in an ELSS fund and claim tax benefits. Again, say you're late and you want to start off from December. You may not put the entire money in December. You can split it over, say, the next 4 months and put that money in an SIP. So the second way to mitigate the risk is to stagger your investments, because equity markets are volatile. We don't want you to invest at one point in the market. So staggering helps. So you end up buying more units when the markets are low, and you end up buying less units when the markets are high.
Right.
So that helps you take care of your risk. One more very important measure to mitigate the risk is to invest over the long run.
Right.
So you need to compulsorily look at long-term investing if you want to look at equities and you want to de-risk yourself.
Correct.
So historically it has been proven that equities held over the longer period are less volatile, or they fluctuate by a lesser amount vis-a-vis holding them in the short term. So that's clearly why I feel that equities, one should have an equity component in their tax saving. Again, ELSS is a good way to start investing in equities because it's a diversified equity fund that is being offered. So that's a good advantage. But even if you are slightly risk averse, you can have some component allocated to equity. And once you get comfortable, you can keep increasing that component.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.